Weekend greetings, fellow traders. This is Austin. It's January 29th, Sunday morning, doing the weekly newsletter here, and I'm going to make this one public. A lot of the newsletters I talk about more technical things or insider stuff. This one here is just going to be generalization of the markets currently, and by currently I mean the last couple of years anyway, and probably going forward for a while. Needless to say, there's been a great contraction in our industry. There's just a lot fewer traders, period, from all sides. There are fewer algo computer programs. There are fewer large speculators. There are fewer small speculators like us. There's just fewer, period. All right? And so the markets have become thinner, and their behavior in some cases has changed noticeably, but there's still patterns to it. Just because we understand those patterns doesn't mean we can take advantage of them. You know, in some cases, the market, a certain market or symbol is simply untradeable, and I'll define to you what I mean by that and describe it. Just because we understand something doesn't mean we can exploit it where an edge doesn't exist. There's an old saying that says, well, you know, the markets are efficient and their purpose is to take the, most money from the majority of participants. That's true to an extent in my mind. You know, there's something to be said for an efficient market, which actually moves and takes money away from people who don't understand which direction it's going. In other words, they're fighting the direction or trend. And then there's a different definition for a market that's efficient in the sense that it goes absolutely nowhere, and whichever side you take is not right because there is no side that prevails other than sideways. So let me get right to it on what I mean from the market's change behavior now. We have crude oil futures, 5-minute chart, pit session only setting up top, and we have the S&P 500 bottom. These are the most recent sessions as of this point in time. It would be last Friday, January 27th. So anyway, and Fridays are not unusual. For years and years, Fridays have been a quiet session relative to the rest of the week. Obviously speaking, majority of the people who move the markets or create the markets, however you want to say that, take Friday afternoons off. You know, they square up positions. They get done what they want to ahead of the weekend, and then that's it. You know, they stop doing what they're doing, and so therefore the market stopped too. This is nothing new in that Fridays are dull. They're just more dull to an extreme than they were in the past. Part of that is volatility is at all-time historical lows again. One of the, I guess you could say, world government goals or objectives is to drain volatility from the markets because they know investors and people who watch the news don't want to see volatility. Scares them, quite frankly. They don't want to see, well, the Dow was up 200 points today. Oh, the Dow was down 300 points today. The Dow was back up 400 points today. Investors freaking hate that, and that's what the market thrives on as far as politicians and so on. You know, the backbone are people who look at their IRAs and 401ks and see them either going sideways or up. They don't want to turn on the news and see the market going all over the place. Scares them. Then they don't spend, right? And then the economy slows down or stops or goes backwards. So by government design, volatility is controlled to be as low as possible so that the market doesn't make big swings. And when you take volatility out of the market, then you take traders' potential away, because if it's not going up or down, there's no possibility to make money. And there's the self-fulfilling hamster wheel prophecy, to mix my metaphors. So with that in mind, the opening range definitely, without question, dictates all of the remainder of a pit session for any market, any symbol, end of story. I've been doing this for years. I can't remember how many years ago it was that I made this discovery. This is not an invention of mine. This is a discovery, and that the markets will move away from the open range to statistically probable price levels. And they've held up for all of the years I've walked this forward, traded it forward, and they hold up for all of the years looking backwards. It is a absolute constant in the market. This is the intraday market profile, period, end of story, above and beyond all else. All right? And so we interpret that, we understand from a statistical probability basis that on any given day, any symbol, this happens to be crude oil, but could be anything else, any given day, a symbol trading at or below its open range wants to go down and fulfill 233% below, or I should say minus 233% below, or positive 233% above. They just do. That's a statistical, mathematical fact. There's no arguing with that because it's an exact science. It can be proven with hard data, lots of it. Okay? So we don't know if this is going to happen or not from any bar on this chart. We never know if it's actually going to do that or if it's going to do this and then go back up and hit this one, or continue on to infinity and above, or chop inside the open range. We have no idea what any given day is going to do. We just know that a collection of days are going to do this, but we don't know if today is, so you can't bet the whole farm on that. You cannot walk into a session and say, well, it's trading here, so it's going to go there. So therefore, I'm going to short the living hell out of it until it goes there. You can't do that or you'll get destroyed, because on any given day, it could be that 10 percentile that does not. And if you aren't prudent with your risk management, you'll blow out huge losses on those days. So we understand this is what the market wants to do. And whatever I'm just speaking hypothetically here, whatever your method of entry is, whether it's shorting pullbacks or whether it's shorting breakdowns or some combination thereof, what the market is designed to do these days, I'm gonna flip to a 1 minute chart so we can see this clearly. The market is designed these days by computer algos, by HFT programs, to thwart that process. Whatever you do, whether you trade pullbacks or whether you trade breakouts or both, the market is designed to take you out of your position. They used to call us shaking out the weak hands. Now you can call us shaking out all hands, because that's what a terminally sideways market will do. So here on Friday, for example, let's say, and just hypothetically speaking, you're trading breakdowns. And so you determine, for whatever reason, where's my line? That this is key support, and right here, and this is just a random line that I've snapped on here. This is key support to you, and so every time it breaks down, because of whatever your hypothetical methodology is, you're going to short it. So it breaks down, and in the past, crude oil was a real breakdown, breakout symbol. It would break key levels, and it would keep going a long ways, like 100 ticks or more. Several years ago was not. Several years ago, I targeted 100 tick trades. That's what I was looking for gains. And if I got stopped out for plus 40 or 50 ticks, to me that was a failure. That was just a consolation prize. And if I got stopped out for plus 75 or 80 ticks on a trade, I'm like, well, that one almost went the distance. That'll do. There's $750 or $800 a contract. That'll do. Nowadays, that might be the entire day's range or more, and picking off 40, 50 tick trades doesn't happen with any regularity. If you catch one of those a week or so, that's a miracle. Meanwhile, this is what happens. So hypothetically speaking, short a breakdown, and you can see where they sell off, and then all of a sudden, this buy pressure comes in. That was just the market trapping these shorts. The market is identifying, and the market being computer algos, by the way, when it's thin, when there's just not a lot of liquidity, they can see these orders resting here through the millionth of a second flashes that they spoof in the market, and they can tell where the orders are, to keep it simple. And so they trap the shorts, and then they hammer them up, and then they come back here. And so then the pullback traders will short the pullback. So they'll short here, and then they'll take it up a little more painfully, and they'll get they'll either take out the pullback traders to the exact tick, or they will force the pullback traders to widen their stops, because the pullback traders have been taught, well, I caught the pullback and it just stopped me out, and then it went back in my favor. So what I need to do in order to prevent that from happening again is widen my stop. And so here's what the market does. This is a hypothetical level, but this is a realistic process of what's going on. So they break down and they fake them out, and then everyone's like, okay, well, I'm not going to be faked out by that again. Here's the real level. I see it now, so I'll just wait until that happens. And the pullback traders are waiting. Okay, I'm going to get short again. I got shaken out over here. I'm short again. Okay, that's fine. And then the market comes along here, and it does this little blip, and the breakdown traders get short again, and they immediately get stopped out. And then the pullback traders get stopped out into this spike here, and I call this back chop. And that's purposely designed to take out these people here. And so they back chop that, and then they come back, and the pullback traders one more time are like, all right, what the heck, short it one more time, and give it a chance. And they back chop it again, and so then they take it to the highest swing high of that point, which was merely a trap. Look at that. It goes right up, it's designed to take out the stops, and then comes right back down. Right? This was a designed trap by the $100 million computer programs to wipe all of you pullback traders out. Then they break it down again, and then the breakdown traders are like, all right, here we go. Party time. This is what I've been waiting for. I'm sitting on X number of chop stops so far. This is going to make up for that, or I'm done for the day. And so they break down, and then they back chop it again, designed to take out all of you breakdown traders. And what happens after that? After they back chop it up, then they go down to where everybody figured it was going to go anyway. Listen, the pullback traders are getting short. The breakdown traders are getting short, and everyone was right. But it's too late, because the market kept chopping and chopping and chopping and chopping and back chopping and taking everybody out. Doesn't matter what your method or system is. You cannot hold stops. And for the people who were duped into thinking a wider stop would work, and so these pullback traders here, whatever stop they're using, getting stopped out, stopped out, stopped out, and then when they get short here one more time, like, all right, I'm gonna widen my stop and not get shaken out. The market ain't gonna fool me again. Guess what it does? Goes up to the highest high yet, shakes you out anyways for a bigger loss than you're planned on, and then it goes in the direction that you expected. That is really, really, really frustrating. And that is really why so many people have tossed the towel. They cannot deal with the chop. I'm here to tell you, in crude oil, I don't see a solution to that as thin as the market is right now, because there is no solution to chop. You never know when it's going to stall anywhere here or go 80 ticks higher the other direction and just cream whatever you tried to do on the sell side. You never know for sure. And so this constant sideways back chop is what makes crude oil untradeable, in my opinion, at this moment in time. And by untradeable, that is impossible to control normal risk reward. And that's not just the most recent session. It includes the session prior to that too, and the one prior to that. Here's the session prior. There's the open range, and so they're trading outside the open range, and they pull back, and then they explode upwards. Well, if you're able to catch this explosion somehow by a pullback or a breakout, then you caught whatever minimal distance this went, 30, 40 ticks. But then after that, it's just back chop. After that, whether you're getting long on a pullback or a breakout, it doesn't matter, because they fake them out up, and then they back chop them backwards to take out everybody. All the longs here, whether you're a pullback trader or a breakout trader or both, they're shaking you out. And then they're shaking you out again, and they're shaking you out again while they go nowhere. This is a dead market. It's efficient in the manner that neither side can win. Back in the day when the markets were more trendy or directional, they were efficient in regards to shaking out most of the people who had a bias, the wrong bias, I should say, but the ones with a correct bias were rewarded handsomely. In other words, if you could see which direction the market was going, you could make a lot of money. These days, many markets don't have a direction. They go nowhere except sideways all day. You can't be right because there is no correct side. That's the difference between today and yesteryear. I hate to be one to, point out a problem in life without a solution. And there are solutions to current price action in current financial markets. Quite frankly, nobody knows if or when they will return to historical behaviors. Nobody knows if there's going to be a return to volume and liquidity and open interest that there was in the past. We don't know if this is the new reality for some amount of time in the future or anything in between. I can tell you with quite a bit of assurance, we're going to see volatility this year and every year, periods of it. We're going to see times where the markets just make gigantic moves for days or weeks at a time, and everyone's like, all right, everything's totally changed. What we were doing before in the scalpy mode, now look at it. There's so much money on the table. I'm missing out on so much, flying all around, da da da. And in my opinion, it will revert right back to what we see here, some semblance of. I think we're just going to continue to have periods of high volatility and then much longer periods of low volatility until something systematically and dramatically changes in the markets. So that being the case, this is what we have to work with, and we have to be realistic about it. If you're not realistic, you can't be successful. It's that simple. And on Friday, the stock markets were a little more forgiving. Here's the open range, and then they trade below it, and they're giving sell signals, and they come back up, but they don't make those abrupt spikes. And so you can see price. Let's say you're a pullback trader or a breakout trader, and you're getting short. If your methodology is any good, like ours is, quite frankly, to be honest, it's going to give you sell signals where you need to be short, and then the market is going to give you time to react to that. It's not just going to sit in a straight chop mode like it did all day Friday, in one zone, chop the living bejesus out of that, and then it moves off to the next spot. So you're able to manage risk better, and that's important. There's only 2 or 3 days a week out of any 5 on average where you have a realistic chance to make money. Any market or symbol, I don't care what it is, bonds, currencies, stocks, commodities in general, and so on. If you're an intraday trader, on average, you've got 2 or 3 days, sometimes one, to make substantial amounts of money. And then you have 2 or 3 remaining days to make a little bit of money, and then you have a day or two here and there where it's impossible to make any, and you're in survival mode. You're just trying not to lose much, because at the end of the week, you need to be ahead. All right? This tool, above all else, respecting the open range and understanding that, is critical. Absolutely critical to success in today's modern markets. And this is something that we're going to teach and train and profile heavily in the upcoming CM Scalper workshop. For the next 4 weeks ahead, I'm going to be teaching and training and sharing everything I know about how to succeed in today's modern markets, current conditions, rock bottom volatility, totally dominated by computer programs, chopping everyone sideways into pieces and so on. We're going to arm you with tools on how to survive that and overcome. And it's not always going to be like this exactly. There are going to be periods of higher volatility for weeks or months on end where the markets are more expansive and trending and forgiving. And there are going to be periods like this again in the future where it's a challenge to make forward progress while not going further back. And there'll be periods in the future that who can say, who can predict. Whatever the case may be, for the next 4 weeks, and one time only, I'm not going to do this again. After this, I'm going into a completely different mode, and it's going to be, let's just say, a whole lot different than what I'm doing right now. So this is one time, one chance. If you want to get on board, register and save a seat for the program, now's your time. We will show what works, we'll show how it works, we'll show why it works over and over and over again for the next 4 weeks. And at the end of that, you'll have a complete understanding of exactly what to do. Hope this helps. Look forward to working with you inside, and as always, best trading wishes.